Well, good day, traders. Welcome to the last day of the month. And I've just got all the 8 indexes that are on my watch list on. I'm not sure who is trading on this last day of the month. And I'll tell you why I say that, because when it comes to the end of the month, the very last day of the month, we can expect monthly traders to be active in the market. And when monthly traders are in the market, which means we will have a lot of volumes in the market, and that's good news. Now, for those who managed to follow my broadcast on TTR, Trader Talk Radio, beginning of the month, first Sunday of last month, I mentioned that based on price action analysis, we were here on the S&P 500, and we're here on the UK 100, and down here on, German 30, we're here on Hang Seng 50, Euro Stocks 50, France 40, we were here, Nikkei 225, that's where we were, and finally on Aussie 200, we were here. Now, the price action has proven itself accurate, because I did say, because of certain levels that were visible on the market, there will be sellers in the market. So if you're a price action trader, you would not have been surprised by where we are ending up on the month. Now, I repeatedly said during all those times, the fact that we're anticipating that the bears will be in the market did not mean that we're selling off the whole month. I had these yellow areas, which are called areas that the bears would defend, marked in yellow. So on the UK 100, the bears indeed defended that, and we ended up with a lower high. The market is sold off. So, you can anticipate that there will be a lot more selling still in the market. Now, I'm doing a little video clip on TTR for this coming Sunday, so I will talk a little bit more, spend a little bit more time on that and show what price action is telling us is the higher probability outcome. Remember, that's all it is. We are looking at probabilities, higher probability outcome. We'll drill in and look at each of these presently. I was active in the market a little bit earlier on, but I'm always cautious with month end. Typically, I don't trade in over a month, so I traded through the earlier session, Hang Seng, the Asian market, mainly focusing on the Hang Seng stock exchange, and I took some short trades also on UK 100, in fact on these 3, S&P, UK, and German. But I got out pretty early. The market has continued to sell off, so if you stayed in the market, then that's good. So what I want to do is, in fact, the one market that's interesting, which I did mention, was the Hang Seng 50, and I pointed out at that stage that we had a tight trading range here, bear breakout. Started off with a dodgy candle, open of the month, and I said that the bears are going to defend this whole price action area, and the bulls attempted to break out above that, really for the first time a few days ago, but they failed. But we just created another tight trading range. So depending on what's going to happen, they still the US session to unfold, we might end up with a perfect doji on the monthly. Okay, might end up with a perfect doji on the month. But let's have a look at what took place since the morning. 50 on the daily. So this is the day we're going to be looking at. Yesterday was a huge bear candle. So after this 1 bar doji, it didn't close. I mean, if it had closed near its low, it would have been an almost perfect bear high test candle. And the follow through would not be a surprise. But because it ended up as a doji candle, you can expect that any follow through at some point would fail. Now, it means when you go into the market that particular day, you must just stay alert and be cognizant of the possibility of there being a failure. So, bull candle, doji, not a surprise after the doji candle, but yes, the bear sold off, but it was controlled that. When you see a bull candle, which is a doji, after a bear candle, which is a doji, you know this is a bad entry for the bears. For the bulls, this was a bad signal for the bears. Bears had a strong candle yesterday, but because of what took place the previous 3 days, we would expect there to be a bit of failure today. Reversal, I didn't expect it to be that much, but you know, it could be anything. I thought maybe we'll just test the moving average and then continue to sell off, but that didn't happen. So we trade what we see and we kept the probabilities in our mind. Let's just get down to our 5-minute chart. Okay, so this is a very interesting chart. So on the open, remember, I'm always saying, if you are trading the 5-minute time frame, the first candle of the day gives you a lot of information. I'm just moving my Fibonacci's out of the way so we can see a little bit more clearly. The first candle of the day closed here yesterday, huge gap up to here. That's where the market opened. Sold off at some stage. So the bears were pretty strong at some point of that candle. I was watching that candle unfold. Then the bulls came in and you kind of thought, oh man, okay. After the previous day closing here, if the bears were strong, they would have at least closed just beneath the low of yesterday. We had a gap up, fine. Bulls were strong to create a gap up. But if the bears had been strong, they would have reversed it and closed beneath here and maybe would have gone sideways or carried on selling. So that tail gives you so much information in terms of what's likely to happen in the day. At this stage, with just that candle, all you know is that the bears are not strong in the market. If the bears had been strong, they would have been, they would have closed down here. Then we look, of course, at the, wait for the second candle. Bulls tried to break out above that and failed. And we ended up with a bear doji, just like the other bear doji we were talking about. And with that bear doji, had the candle closed all the way down here, that high test would have been a perfect one, because looking at that one in the first candle, we said, okay, the bears have reasserted themselves. Then you get an inside candle, a bull inside candle. These three candles already are a huge challenge for the bears. So that's saying that the bears that we thought would follow up and sell off for the rest of the day are not as strong as we expect them to be. Now, depending how you trade, you watch this particular candle, you can take a trade here. Okay, market goes up. You're going to wait for the candle to close. You can take a trade there. Pretty difficult to do that as market is unfolding. So the best thing would be to wait. Okay, even inside candles breakout mode, failed breakout below the bottom of the inside candle. So the market went on once, twice, 3 times. The bears have tried to break off and failed. Now we have a strong candle, right closing above the open. And we have a follow-through candle. So from here, we know the confirmed breakout, and you're looking to jump in. In terms of trades that you could take, wrong color. So if you relatively seasoned as a price action trader and quick, you could take that trade as the market is unfolding. Okay, that's a legitimate trade you take. And when you take in the first trade, your stop is not here, stop is down here to measured move. So it's a pretty wide stop. And that's perfectly fine and legitimate for a first trade, because you don't know, it might just bounce and come back and do a double bottom here and accelerate up. That's why that first trade has to be a measured move stop trade, which is way down here somewhere. So there is a measured move. That's where it goes. Because if you're right with that measured move, you know at the very least you'll make 1-to-1. So if you're taking that trade there, with your stop there, by the time the market got to here, you'd have got your 1-to-1 on that already. But bear in mind that the first trade we're taking is in the basket of reversal trades. Reversal trades, higher possibility of profit, but low probability of success. So you must be willing to put a wide stop in and wait to see what happens. If you didn't take that, but you knew that's a legitimate trade, because you wanted to see what happened in this candle, you know that you'd have entered there, so then you can take a trade there. You can take a trade there. That's where you take a trade. Now, when you take that particular trade, after that trade, or even if you hadn't taken that, then you can put your stop here, a tighter stop. Because that's essentially if you're taking all the trades, a second trade. So that's where you put your stop to be a tighter stop. Okay, so then you get a breakout, and after the breakout, you're waiting for a pullback, 3 bear candles. If this was a bull candle, that would be a nice trade to take, but it's a bear candle, we have to wait and wait for another pullback here. And that's a doji candle. So again, you've got to wait. And as the market continues to pull back, the next legitimate trade would have been here. Up here, which would be 1, 2, a wedge pullback, 3 pushes down to the moving average. So that's a trade you would look to take. Over this candle there. Oh, you obviously notice that with this particular trade, you would not have been triggered into the trade here. So when I don't get triggered in the trade by the next candle, I like to cancel the order and wait again. But that would have been a perfect entry if you'd been triggered in. Now, because you're taking that trade, your stop would be here. Okay. We get a converging triangle. And I point these out every now and then, the market converging into a particular point. If we were to extend this, if the market was to continue converging, it would mean that at some point, we end up with just a straight line for price, and we know that is not going to happen. The market is not going to allow that to happen. So there will be a breakout up or down. So you get a two-bar reversal. Very difficult to trade because they are dodges. But there's other ways to look at it, inside, if you look at the bodies. But there would be a legitimate trade to take. And again, if you look at this trade as you'd look at that, correct trade, first trade to take would be here. If you didn't take that for any reason, because you're not comfortable with taking that kind of trade, or that trade here, you wait for the entry candle and you take that trade. So we're taking the trade above this particular candle. It's a trade that we take now. When you take in this particular trade, you can put your stop here. And of course, we do get the breakout, but even within that breakout, pull back, that inside or dodgy candle is a pause, and that's a legitimate pullback trade that you can jump into. So it can be quite a profitable day if you are patient and calm. And if you don't take any of the trades, if you miss the trades, that's fine. Take the next one. Breakout trade, your stop is here. Then you get a breakout. This line that we have is the 50% midpoint of yesterday. So that's a level that the bears would like to defend pretty strongly. Because it's half the movement, half the range of yesterday. The bears, if they are strong, they don't want the bulls to get above the midpoint of yesterday's range. Bear in mind what yesterday looked like. I mean, it was a huge bear day. So now you get a test of it, breakout, bad breakout, poor breakout for the bears because they would want to follow through. But it's a breakout nonetheless, breakout in a pullback. That trade you can take. It's a low probability trade. Very low. I wouldn't take that trade because of this failed breakout here. But you can still have a look and see if there's acceleration up. We do get acceleration up. Then you can take that trade. So a good thing to always ask when you're taking trades is, what are the bears thinking? So here we're buying because the market is clearly going up all the way from here. Where are the bears and where would they come back into the market? So the first place you would expect bears to come back is here to defend the midpoints of yesterday. The converging triangle is clearly evidence of bears in the marketplace. Otherwise, the bull breakout would have carried on all the way from here. When the bears tried to make it fail, and that didn't succeed, then we broke out above the 50% midpoint. But right here again, the bears came into the market to try and make the bull momentum fail. But although we have bears, there's no case for bears selling here. We only consider selling if we get a close beneath the moving averages and a pullback. Then we can jump in and say, okay, let's jump into the trade. So we don't have that yet. Doesn't mean that there's no bears in the market, because the next level of resistance that they're going to jump into is the high of yesterday. So the bears that created that huge bear candle from yesterday, they failed to stop the market here, tried. They failed to stop it here. So this was the measured move of the first candle. All the way here, the bears were trying to make the market fail, and they failed. We stayed above the moving average. They tried again here. They failed. So the next level is here, and you can see as the bulls accelerated up. Now, if you've been buying up, and now you've banked some profits, and you can comfortably take one of these trades, any of these trades, and put your stop here. If you're taking that, put your stop here. If you're taking that one, you can put your stop here. But as you get towards the high of yesterday, that's that line. You really don't want to take any further trades until the bulls break out above it, pull back and accelerate up. And clearly at that point, in spite of all their strength, bull breakout, triangle pullback, bull breakout, breakout, trading range pullback, bull breakout. Now we have a failure, complete failed breakout. At some point, it was a strong bull candle, failed breakout. Strong bears, those who have the ability to put a measured move stop in at this point, will start to sell. They will start to sell because they can sell here, but they put their stop here. That is where you got to put your stop, because bulls could come back and accelerate this up. So the strong bears will start to sell here. Everyone else could wait because the opportunities are always there. Market creates another trade, another expanding, sorry, converging triangle. Same pattern that we had here. It's a much smaller pattern, but the same forces are the same. It's a pullback, breakout, pullback, breakout, pullback. So we expect that out of the converging triangle, there will be a breakout. And the forces at play now are the strong bears. So there is a breakout. At that point, you can jump into a trade. There, I need to mark the bear trades for you. So of the markets that I spoke about, this is one that I actively traded. I only had one trade each on the other ones, but I had multiple trades on the Hang Seng 50. So you can sell here. If you don't sell here, then you're going to have to wait for a pullback, breakout, pullback. There's a trade you could take. Stop is still virtually the same. Stop. You've taken that trade, your stop is up here. You take that trade, your stop is still up. We don't put a tight stop until we get another breakout, then we can put a tight stop. So that's a micro double top at the EMA. It's a breakout, pullback, first entry, second entry at the EMA, one of our strategies that we actively trade. Just like we also had here, we had a breakout, pullback, and pullback. First entry didn't trigger here. Then you get a 2-bar reversal here, inside candle. It's just before the close. So before the market closes, remember when it opens, it's like the news. So while this is a legitimate setup, but taking this, it's a low probability trade because the market can gap up at the open. And if it does, then we'll be sitting with a losing trade. But if we didn't have the close coming in, that would have been a decent trade to take at that stage. So I'm gonna just mark it, which because the price action patterns will repeat themselves. So when you do see that and there's no open, or if you have red news, it's the same impact. You don't take a trade as a red news. So that's a 2-bar reversal taking place right there. So, and you've had, a lower high double top here. So you can mark it with that or mark it with any of those, which was a bad signal for the bears because it wasn't a bear candle. But the point is, if you take that trade, you can put a fairly tight stop there. Then, if you get acceleration down, you can tighten the trade. If you look at this breakout, the gap downs breakout, breaking up in this level. We have a test. It's a wedge pullback. Went up once, twice, 3 times. I would wait for price action to show a bear continuation because these gaps tend to close. So you don't want to take a trade, get the gap to close, market goes up, and then come back. But if you do get bear acceleration, then wait for the next pullback, and you can take that trade. So that's Hang Seng 50. Let's have a look at UK 100. Again, just the view on the daily chart. Huge bear candle, followed through yesterday, so expect some bears to carry on. So let's mark in the that doji candle was the open of the session, open of the London session. Okay. Now, when you get that kind of open, you would expect to end up with a trading range kind of day. And if you have a look at it, unless you jumped into the market at the European Open with this reversal, there's no legitimate way for you to jump into the market here. You're selling at the bottom of the trading range. And at that particular point, you can't jump into there. You have to wait for a little bit more action. You get a breakout, get a pullback, good setup for the bulls. Then you have an outside candle, which is also a trading range price action. And again, the problem that you have is if you sell here, you are selling at the bottom of this little trading range, and you also got support coming, which is a low of the previous day. So in all of this, there's no legitimate way for you to get into the market. Then you get a strong bear candle. This kind of bear candle has the potential to shift the market into a bear's market. But again, you are right at the low of yesterday. The low of yesterday, the market can just bounce and accelerate up. What to get instead, so from the open all the way down here, there is no legitimate entry for you to jump in. If you're willing to scalp, which means you just sell when you see a bear candle, and if you see a pullback that goes against you somewhere, you exit. It would have been hard to hold on to the trade even if you saw that, because that's a fairly reasonable reversal setup for the bulls. Even if you took that and you saw that, you really have to hold on to your trade quite strongly. So scalpers possibly could have made some money, but for swing traders, it would be best to wait. Get to the test, the low of yesterday, and the bulls tried to make the market fail, but you get an inside pattern, breakout mode for the bears. Bears get a decent enough breakout, but the breakout fails. So we're going to wait to see what happens at the test of the breakout point. And we then, for the first time, get a decent enough entry for swing traders, those who wanting to hold short for as long as possible. Let me change that. So that would have been the first legitimate stop order entry into the market. You are placing your order here, and there's your key level of support. There's the open of the day, so you can put your stop anywhere above here. Then you do have the breakout and can hold on to your trade. Now, if you just opened your charts at the open of the London session, very difficult to get in here unless you're scalping and saying, if we get the reversal, then I can quickly get out. But if you had been in the market from the open of the European session, let me just look at that. European session opened here. This candle. So if that's the open of it, and you had seen all of this and analyzed all of that, so let's do a quick. At that point, by the market opened, you'd have seen these three attempts by the bears to turn the market. Here, bulls have tried 3 times. And you come into the market and you turn and wonder who is going to control the market. I mean, every time the bulls try to go up, the bears make it fail. Then for the first time, we have a moving average gap bar. The first time in probably since the open. Let's have a look at it. So if you have a look right from the open of the day, the first time in 7 hours, 8 hours, we've had the bears able to put a full candle beneath the moving average, which means the bears are strong enough to potentially turn the tide of this bull move from the open. Also, if you have a look at the way the market has been going up, this, would you describe this as a strong bull breakout? Or it is only a bull trend in a developing trading range? Because every time it goes up, we get a pullback, goes up, pullback, goes up, pullback. So it's two-sided price action, but yes, the market is going up. Then here we have the bears controlling the price action for the first time. We also have another one here, although it's a bull candle. So as this market opens, if the bulls are strong, in the strong breakout above this wedge pattern coming from this moving average gap bar, and you need to see follow through. Yes, they tried, but tails on top, so that's a dodgy, indecisive price action. Follow through strong, but then we have a weaker bull candle and an immediate reversal of that reverses this whole breakout. So strong bears will jump into the market here. Again, what is a strong bear? That is bears who are prepared to put a measured move stop into the market. So these traders would see that and say, hey, this thing has just reversed, back candle, there's a follow through. I'm going to sell right here. And why do they put a measured move? Because if they're wrong, the market will accelerate up, might take off this high and then sell off. So just like here, market went up, took off that high. So if you put your stop above there, you'd have been stopped out. So that's what they're afraid of. So put a measured move stop. Then as it starts to accelerate down, they'll have the opportunity to move their stop down. When the London market opens and they see that, they know the bulls potentially have the opportunity after all this to accelerate the market up. But when they fail to do that, and we have this breakout and pullback, this gives these bears the opportunity to now pull their stop down to that level. And after we go down here, they pull down to that level. So they don't necessarily have to add in on the way to support because market get 10, but at least you can start to pull your stop down until you can legitimately jump into the trade. Now, if you prefer scalping, by all means, just sell. Put your stop here and hold on to it. If the market turns, be able to get out. If it starts to go up, be able to get out. But that's a very difficult way to trade. High frequency trading, you can't scalp in and out, scalp in and out. Like here, you would have probably taken 6, 7, 8 trades. Buy, get out, buy, get out, buy, get out, buy, get out. Still make, the 1%, whatever it may be. But you can't scalp and then decide that you're too tired to scalp. You want to trade as a swing trade. It doesn't work. You will lose money. You must choose a particular way of trading and stick to that way of trading. Okay, so after taking that trade, if you want to take a breakout trade, you can take that trade and your stop is there and you pull that stop down. So that's another legitimate trade you could have taken. Okay. All right, so there's a whole bunch of trades if you were in that market. Now, there is news coming on later on. It's end of the month, good news coming. So many forces at play in the market, so just be extra cautious. S&P 500 will trade all the way to the end of the day. So almost the same kind of structure as UK 100. But what I want to look at here, just for time's sake, to give you some insights. So we have marked on the 5 minutes. So we have the low of the day. We have the high of low of yesterday, high of yesterday. We have our 50% pullback. So the bears were able to defend that midpoint, and the market is selling off, and we are back right at the open. Now, it being the last day of the month, news on the horizon, everyone will be comfortable with a dodgy candle. But the bears who have been controlling the market want to get down here and close right at the bottom of the day, if not break below it. Because if you have a look on the daily, what we had after this huge bear breakout was a dodgy candle, which meant the bears were not strong enough to follow through yesterday with an outside candle, which is a trading range candle. So it's indecisive price action. What the bears need to control the market going into tomorrow, which is next month, is a close beneath here of any kind. If the day ends up as an inside candle, it means that going into the month, it's indecisive price action. We cannot start off by saying the bears are going to dominate completely. If you ever look at the monthly chart, my Fibonacci's are in the way, but we can do that. What the bears want is to close. They close at the low of today, then they have controlled that candle. We still have price within this dodgy candle, which was in the month of May, and the bears have managed to create that double top, but they need to close on the low of today to give them the opportunity to sell and test this level, low of 2022, and give us lower prices for the rest of the year. So the market favors the bears, but if today we get buying and the market pulls back, that tail could indicate probably more sideways price action going into the month. It's kind of where we are. Again, doing a little video for Sunday's Trader Talk Radio on all these indices. I'll have a look at the end of today or first thing tomorrow to see where the market actually closes, and then just give my views on what price action is telling us. But as of now, we did say that the high probability of selling beginning of the month, and that's where we've ended up. So price action still gives us greater probability, higher probability of what is likely to happen. Market fundamentals, of course, drive the market, but price action gives us insight into what's taking place. All right, guys, so we will catch up on Sunday. I'm not live again, I'm on video. Alternatively, we'll see you next week. Thank you very much, Marlon. Thank you for hosting, buddy. We will catch up next week.